everybody. I'm Janet Raymond from the Greater Providence Chamber of Commerce. I'm sitting in today for Lori White, and we are back again with episode 137 of Chamber TV. And today we have a really interesting topic that we're going to be talking about, the Employee Retention Tax Credit Program. And this is a tax relief program established by Congress as part of the CARES Act and the American Rescue Plan to help businesses struggling due to the COVID-19 pandemic, but many employers are not aware of this particular program. So today we're going to learn about who is eligible to apply for it, how do you apply for it, and to get some real world examples of how this program has assisted many businesses. And today we have two experts from Citrin Cooperman to tell us about this program. We have Jen Hogencamp, who's a partner, and Jeff Rogers, a director, and they're longtime chamber members. So hi, Jennifer and Jeff, how are you doing today?
Great, thank you. Thanks for having us.
Oh, well, great. It's great to have you here. So just a couple of announcements before we begin. We are live on Facebook, live on Twitter, and live on YouTube. And we want everyone watching today to come away with everything you need to know about the Employee Retention Tax Credit program. So you can pose a question or a message in the chat box as we go along, and then we'll pose those questions to Jen and Jeff following their presentation. So without further ado, I'm going to turn it over to Jen and Jeff.
Great, thank you. And thanks everyone for joining us today. And thanks to the Chamber for having us. We're going to go through quite a bit today, but the couple things that I wanted to touch upon first is there's been a lot going on this year, as everybody knows, and whether it's the PPP loan, the employee retention tax credits, there is so much out there for businesses and companies, and it's been very confusing. The guidance is continually changing. And even if you go on the IRS website, you still are not going to be sure if you can even qualify. So we're here today to kind of put some of that to rest. Obviously, there's different opinions that are taken by different accountants. So kind of throwing a disclaimer out there, you know, there's definitely guidance and be comfortable with what you're doing and what your accountants are telling you. There are people that are kind of opinion shop, and the guidance has changed so much, and it changes. There's probably going to be more guidance that comes out and changes it again. But please reach out if you have any questions, and tell people there was initially, and this is the biggest thing to this, you were not allowed to take PPP and employee retention tax credits at the same time, and that changed. And now if you're eligible, you are able to do both. So it's a big change. There's a lot of money out there. We've helped a ton of clients through both processes. I in particular helped a tremendous amount of clients with the PPP loan. Jeff is our resident expert on the employee retention tax credits, which he'll get into. But like I said, it was so hard on so many companies last year that this money's out there. It's something that you should go after if you're eligible. But I'd like to now turn it over to Jeff. He's going to go through the eligibility criteria, some examples and things that we've seen. I have had clients that have had in the millions, whether it's 2020, 2021, of these retention tax credits that have really helped out their businesses with keeping people on payroll and helping to float the business while times are tough. So I'll turn it over to Jeff. He'll share with you some of the things that he's seen in the industry, and go ahead. Thanks again for having us. We'll have questions at the end, so please submit questions. We'll both come back on at the end. So whether it's PPP related or ERTC related, please let us know.
All right, thanks, Jen. Yeah, and as Jen mentioned, definitely feel free to send along any questions, as well as, you know, if there's anything in here that perhaps you have a different view on, because, you know, that there is still a lot of areas that could use clarity. And so with that, we'll dive in. Do you mind moving it to the first slide? All right, at a high level, this employee retention credit is a refundable payroll tax credit. And, you know, what that means is that you'd be recovering it through payroll taxes that were previously paid in or would be owed, both employer and employee. And what makes it refundable is that if the credit that you calculate exceeds what you've paid in, you will get a refund. So you can almost look at it as sort of a rebate on employee wages paid during the pandemic. And what it's intended to do is it's there to encourage businesses to keep employees on the payroll as opposed to laying them off. You have to show eligibility, and eligibility is based on employer size, which we'll get into, and the impact that the pandemic had on you. And there's a couple of tests: revenue decline, and whether or not you were impacted by a government shutdown. Next slide. Wanted to start off first before really getting into it on the different forms of legislation, because as Jen mentioned, you can go out online looking for answers, but it's been evolving, and you might walk away with something, the wrong answer, if you're not aware of where the appropriate guidance is. This was all introduced with the CARES Act, same time that the PPP loans came up. But at the time, there was a significant restriction placed, and that was that if you were receiving a PPP loan, you weren't going to be able to be eligible for the employee retention credit. So with that, many businesses didn't pay this any real attention, because a PPP loan, getting that forgiven was a far more lucrative benefit. But 6 months later, or not 6 months, 9 months later, the end of the year, the Consolidated Appropriations Act of 2021 came out, and the first thing it did was extended ERC through the first 2 quarters of 2021. The CARES Act originally was only having it in place between March 12th and the end of 2020. Consolidated Appropriations Act extended it through June and really made the benefits more lucrative. They eased that restriction that said that you couldn't receive the credit if you received a PPP loan. Only caveat that they put in place was that you couldn't use the same wages for both. So with that all of a sudden opened up the door for many companies that previously didn't think that they were eligible, but some still aren't aware that change went through. In March, the American Rescue Plan Act of 2021 came out. Basically, that extended the availability of the credit through the end of 2021. With along the way, there have been frequently asked questions up on the IRS website, particular to 2020 and how it would apply. They were helpful. A lot of the questions are helpful up there, and they're still up there. They haven't been updated at all. But the problem with those is that they're not legal authority. So all along, we've been waiting for guidance on exactly how to implement this thing. And actually, after the Consolidated Appropriations Act came out, we were still left with the question of okay, granted, we can't use the same wages for both ERC and PPP, but how do we go about doing that? And that's where Notice 2021-20 and Notice 2021-23, which came out in the March-April timeframe, they clarified a lot of issues. Not all issues, but a lot of them. Go to the next slide. All right, now moving into the credit criteria, how you determine if you're eligible. If you experienced one of the following during 2020 or 2021, for now we're going to focus on 2020 because the rules changed. But if you experienced a 50% decline in revenue in a particular quarter as compared with the same quarter of 2019, that would make you eligible for the credit for that particular quarter. If you didn't experience that kind of decline, but you were impacted by a full or partial suspension of operations by way of a government shutdown, you would also be potentially eligible. Couple items to note. That 50% decline in revenue allows you to be eligible for the quarter that you sustained the drop, but also the following quarter, and through the quarter that until you reached 80% of your 2019 level, or 12/31/2019. 2020, whichever came earlier. You're supposed to use your tax method of accounting to determine whether or not you're up or down, whether you're down to 50%, so if you're on cash method, you're supposed to be looking at it from a cash basis perspective. If you're getting eligibility by way of government shutdown, you're only looking to that specific period of time in which you were impacted by the shutdown for eligibility. And in some cases that's less than if you had a quarter that was eligible. In some cases it could be more. And last thing here is that aggregation rules need to be considered. And we're going to go through an example in a minute, but if you have multiple businesses with common ownership, you have to look at them together to determine eligibility. Next slide. Okay, if you've determined that you qualified for the credit, then now you're going to determine which employees' wages would be creditable. And to do that, you first have to look back at 2019 and your full-time employee headcount. You basically look at it on a month-to-month basis through 2019, and you tally up how many employees you had that either worked 120 hours in a month or averaged 30 hours per week, in a given month. You look at it monthly, you total them up, divide by 12, you've got your monthly full-time employee headcount. From there, if that number was less than 100, then any wages paid during an eligible period to any employee, not any employee, but almost any employee during the eligible period would be creditable, subject to a limit of $10,000 in wages and 50% of those wages. So it's a 50% credit on up to $10,000 of wages for 2020. The maximum credit you can get on any employee is $5,000. If you were over 100 employees on average during 2019, you're only going to be eligible for the credit on wages that you paid to employees to not work. Now, I just want to point out that this is one area that there's differences of opinion, and it relates to what you do with part-time employees. Do you have to convert them into full-time equivalents for purposes of your full-time employee headcount? There's various opinions on that matter. There's a reference to section 4980H in the FAQs and in notice 2021-20. And the committee reports do indicate that it was the intent. However, the IRS has remained largely silent. And there are a few additional restrictions, but we'll get into those in more depth as we move along. So next slide. All right, now with 2020, with those rules behind us, I just want to quickly talk about 2021 just so we can see the differences. First, when you're determining if you're eligible in 2021, instead of looking to see whether you had a 50% decline in revenue, you only needed a 20% decline. And same fact pattern. You through the quarter until you get back to 80%. So it's 20% down instead of 50%, and you can look to the previous quarter. So if the fourth quarter of 2020 was down by 20% as compared to the fourth quarter of 2019, then the first quarter of 2021 is an eligible quarter. If the first quarter of 2021 is down, then the second quarter is eligible, and so on. Next slide. In addition, that 100 employee threshold that was in place for determining which wages qualify and which ones don't has been increased to 500, which is obviously going to allow far more businesses to be eligible. And in addition, where we previously had a 50% credit, the credit is now 70% of wages. And it's no longer just $10,000 of wages for the year, it's $10,000 per quarter per employee. So adding it all up for 2021, if you happen to qualify throughout the entire year, all 4 months, and you were paying an employee at least $10,000 per quarter, you could be seeing a $28,000 credit for each employee that fit that criteria. Any more than 500 employees, again, you can only take the credit if you are paying them not to work. Next slide. All right, now getting into what are qualified wages. Wages include healthcare expenses. So if you're paying an employee's healthcare, that can be added on. But typically, you're looking at wages that are subject to FICA without regard to the Social Security limitation. You just need to be careful to make sure that you're not taking a credit on wages that you're also receiving another benefit from, whether it be the family medical leave credit or the work opportunity tax credit. And there is some debate over how wages paid to business owners and their family members come into play, whether they're allowed, whether they're not. It really is kind of depending on how you ask, because the guidance is not written overly well. We're going to get into that a little bit more further into the slides. Next slide. All right, before moving over to to talk about the government shutdowns, I thought it would be helpful to tackle this aggregation issue. And we're going to have an example. Basically, I mentioned before, when you're trying to determine whether or not whether you're qualified, you have to look at all your businesses together. And there's three areas that need to come into that where aggregation needs to be considered. If one of your business line, if you say you're a business and you're in several jurisdictions and one of them was impacted by a shutdown, that pulls all of them in. If for a purpose to determine whether you had a decline in gross receipts, you have to consider from that point of view, and when determining your headcount, your employee headcount, you've got to look at all of the employees, all your businesses, if they meet the definition of a control group. And then for purposes of if you do have more than one entity that is part of the group, the credit gets spread out amongst them in proportion with the wages that each entity provided. So next slide, we're going to get into an example. Basically, so if you get brother sister companies, you need to look at it from two points of view. First, do you have 5 or fewer employees that own 80% or more of more than one company's stock? And then if you do, is there 50%, is there common ownership in those entities greater or less than 50%? If you meet both those tests, then you're considered a control group. So here's an example of 7 shareholders that have various ownership stakes in 3 different companies. You see there's 7 different owners of company A, 6 in company B, only 3 of them in company C. So we're going to be looking at whether, which among these would be considered controlled. Next slide. So up top, we're comparing company A to company B. And you'll see 2 shareholders with thrown out of the equation, shareholder 5 and shareholder 6. And the reason is because shareholder 5 owned a percentage in company A, but not company B. Shareholder 6 owned 5% in each, but we're looking at this from the perspective of whether it's 5 or fewer employees. So that's the lowest one. We throw it out. With the 5 that remain, when you tally up their ownership percentages in company A, you hit 80%. In company B, it's 95. So you pass. So in their case, yes, they did pass the 80% test. Compare that to the company. When you compare company A to company C, you're really just looking at the first 3 shareholders, because there's only 3 shareholders in company C. So, so while they do own 100% of company C, they're only owning 60% of company A and 65% of company B. So that would be that those do not pass the 80% test. So you don't have to take it any further. Back to the first one. Now we're looking at the second test is we're basically taking the minimum amount that of the minimum percentage that each of them own in company A, company B, and when you add that up, there's 70% common ownership. So we are over 50%. Company A and company B is a control group, and you'd have to, use both of their employee headcounts, both of their revenues. But if one of them experienced a shutdown, they both do. Next slide. Okay, so now the shutdown part, which is the more, subjective part of the analysis. If you can't get there by way of the revenue reduction, you'll want to look at whether or not you were partially shut down. And in general, it's only going to apply to the non-essential businesses. Essential businesses were not, were deemed essential and, not by default, not considered to have experienced a shutdown. However, as we all know, there are many modifications imposed to all businesses throughout the pandemic. And just because you were essential does not mean that you would not have been deemed to have experienced a partial shutdown, or a full one, but a partial. Basically, you'll see this quite a few times through. What you're basically looking at is whether or not, under your particular facts and circumstances, more than a nominal portion of your business operations were suspended by a government order. And it has to be a government order, a specific one, not just a suggestion, a specific government order. Next slide. A few things that would not give rise to a partial shutdown is loss of customers because those customers, had concerns and did not come out to your business. That wouldn't be considered a partial shutdown. Voluntarily shutting down your business for the safety of your employees, that is not going to be considered a partial shutdown. And shifting from office work to remote work, in all likelihood, will not result in a partial shutdown unless comparable operations can't be performed in a remote environment. Now, reduction in normal working hours mandated by the government, that definitely could give rise to a partial shutdown, as well as the required closing of certain business lines could as well. And the last one that could get you there, I don't know, there's others, but the last one we have here is that if a business is not able to, if their supplier is not able to deliver critical goods and materials because of a shutdown that that's been imposed on them, that can extend itself to the essential business that is their customer. Next slide. So next few pages, there's going to be some examples, and I'm not going to go into in real detail. You'll find that these are all on the IRS website, and I believe they're all in Notice 2021-20 as well. But just to kind of see, where the IRS's thinking is on this, retail business had to close their storefront for a while. They were only able to use their website, or perhaps outdoor, curbside, whatever. That, in all likelihood, will be considered a partial shutdown, even though retail business is an essential business. Next slide. A hospital. Obviously, a hospital is an essential business throughout the pandemic, but there were services, the elective and non-urgent medical procedures that were taken off the table. They weren't allowed to perform these. This, depending upon how much of the practice that represented, that could definitely constitute a partial shutdown. Next slide. Restaurant business. We're all aware of this one. This went through several several modifications. You know, it started with you couldn't, everything had to be offsite, takeout only. You know, then it became, after a period of time, that that you could do outdoor dining as well. And then once indoor dining was opened back up, it was with significant, in most cases, it was with significant modifications in place from the standpoint of, you know, the capacity that you were allowed to let in, the spacing of your tables. All of these things, and if you want to go to the next slide, could give rise to a partial shutdown, and in many cases, you know, would. The only one that probably would be, you know, up for debate is whether or not you're a restaurant that wasn't really relying on indoor dining, but that's, you know, that's in general, restaurants were, you know, impacted, you know, throughout this. And depending upon, you'll see a couple places in here it's highlighted. If the particular restriction had a more than nominal effect on a portion on the business, you could be considered to have a partial shutdown. Next slide. Just to kind of contrast that, though, you know, and with the restaurant, we were talking about how having to spread out your tables and limit your capacity, you know, would be considered partial. The IRS has on their website a grocery store where they suggest that because of the size of the grocery store, requiring spacing is not enough to be considered a shutdown. Even if you have to wait outside for a period of time, that wouldn't be enough to make a grocery store not eligible. They also talk about here, if you're closing down self-serve offerings like salad bars or prepackaged food, or whatever the case may be, in the context of a large grocery store, that may not be, or likely will not be, significant enough to warrant a partial shutdown. Compare that to a restaurant, though, that's not able to provide their salad bar, or their toppings bar, whatever the case may be. The answer could be different. So it's all facts and circumstances. You got to really, establish your position in this particular case, how the restrictions impacted you. Next slide. So as I mentioned, one thing that was very up in the air once the Consolidated Appropriations Act came out was how we interact the PPP loans with the ERC credit. We know we can't use the same wages for both, but we really didn't know what, we didn't know how we needed to keep them separate, or how we needed to make sure that we were following the rules. Next slide. And before getting into that, one of the other key areas of the Consolidated Appropriations Act, this is more a PPP concept, but the Consolidated Appropriations Act introduced 4 new categories of costs, of non-payroll costs, that a business could spend their money on, their PPP funds on, and be deemed to have been qualified expenses for purposes of forgiveness. If you're familiar with the PPP loan, the requirement is that 60% of the usage has to be for wages, 40% can be non-payroll costs. But prior to the Consolidated Appropriations Act, all that was really in that category was rent, utilities, drawing a blank, real estate taxes. Not a lot of expenses. A lot of companies weren't getting there. But then these new categories came into play with the Consolidated Appropriations Act. And the reason it's worth mentioning that here is because, the more expenses that you can, the more non-payroll expenses that you can come up with for purposes of satisfying the PPP loan, the more wages that would potentially be freed up for ERC credit purposes. So you don't want to overlook this. You should definitely be looking to maximize the 40% non-payroll costs allowed. Next slide. All right. So the questions that came about with the with the Consolidated Appropriations Act is, understand how we had to keep the PPP, the wage money separate. Do we need distinct separate periods, or do we have to wait until the PPP covered period is over before you can start, claiming the credit? And what about the taxpayers that had already applied for their PPP loan forgiveness? This came out in late December, and knew nothing about the non-payroll costs that they could take advantage of. Well, how do they? What do we do with them? And another category of taxpayers, those that had gone in forgiveness, and they just to drive home the point that they used all their payroll, their loan money on payroll. They just put every dollar of payroll that they spent, in many cases, way beyond, what was, 100% of the loan on their application. Are they out of luck at this point? Given that they could now potentially claim the employee retention credit. Those are the questions that we had. Next slide. And notice 2021-20 answered some of those, as well as others. Came out in mid-March, 71 Q&As and examples. A lot of them had already been part of the FAQs on the website, but they're now incorporated into the formal guidance. This one was specific for 2020. For 2020, the 2021 version is included in notice 2021-23, but it's basically the same thing. A few of the key things that were provided by that were addressed in notice 2021-20, things that you could consider when shifting to, remote work that would or wouldn't constitute comparable operations, types of modification required by the government that could give rise to a PPP loan. I mean, to a partial shutdown. The records that the employer should maintain to substantiate the credit, and whether or not you needed to, where you need to keep those records. Do they have to be attached to the return? They introduced a, somewhat bright line test for their definition of nominal effect. Before we kind of emphasized, nominal, did a certain modification have more than a nominal effect on the company's business? Well, they gave us a definition in 2021-20. And then the last and probably most significant was that they provided some pretty, from my standpoint, pretty cut and dry examples of how the PPP loan interacts with the employee retention credit. Next slide. So just, a couple points here, I don't want to spend a lot of time on this, but just some of the things that you can think of that you can look to when making your argument that, hey, shifting to home, working from home or working to remote work, really didn't, provide, comparable operations. And also from the standpoint of whether or not a modification, a government modification, fell into the category of partial shutdown. They said limiting occupancy to provide for social distancing could. Services on an employment basis could be considered partial, and having to change the format of your service could also be partial. Again, so it's all facts and circumstances, but that was included in there. Next slide. There's a list of things here, and I don't think this was all inclusive of the items of just the documentation that you should have in your files for purposes of substantiating the credit. And some of it's self-explanatory, how you came to your position that you had a government shutdown, or how you calculated your qualified wages or your employee headcount. But one thing that was key here was that you're not required to attach these to the tax return. Just have in your file in case you ever needed to explain your position. Next slide. All right, so this definition of nominal, all along the IRS have been saying, if such and such a modification had more than a nominal effect on your business, you might be considered to have a partial shutdown. In Notice 2021-20, they defined what they felt nominal meant, and it is more than 10%. If you had to discontinue an operation that resulted in more than 10% of your total gross receipts during the same period of 2019, that's nominal. That's more than nominal, I should say. If you can't quantify it from that point from the revenue standpoint, you can look at it from an hourly labor hour point of view. There's a 10% threshold there that you can use to establish your position that whatever the mandate that was placed on you had a more than nominal effect. Next slide. All right, so this is the big one. The PPP loan and ERC wage interplay clarification. Some good news and some bad news. The bad news was that anyone that had already gone in for forgiveness at that point in time, late December when the Consolidated Appropriations Act came out, that did not list any non-payroll costs or all of the non-payroll costs that they were entitled to on their application, were not able to go back and amend their form, their forgiveness application. Kind of an unfair result from my point of view, because they wouldn't have known all these additional costs. But it's pretty clear in the examples that are in this notice that that's the case. However, they did say that if you just listed all the wages that you paid on your application, and it was well in excess of 100% of the loan, we'll cut it off at 100%. You don't have to. You haven't eliminated your ability to claim ERC on the wages over and above the amount of the loan. And then from the standpoint of what qualifies and what how you separate the periods, it's pretty loose. It's pretty broad. There's nothing that says, oh, you have to spend your PPP money first before you can shift gears to ERC, or you need to keep the periods completely separate. This week's ERC, this week's PPP. Nothing like that. It's basically you just got to, you just have to make sure that you have that you have an ERC eligible period, and that you are not going to use the same wages for PPP purposes. So obviously, this means you just need to keep really good record showing, where the wage money is going. Next slide. So the notice was good, but not great. There's still some things we'd love to see more guidance on. The AICPA has written some letters to the IRS asking that they come out and just clarify some of these things, but even the others in practice. We listed a few things here, and this isn't all inclusive, but we talked about briefly before whether or not your full-time equivalents need to be considered an employee. Heck, nice to see something definitive there. Something definitive that says that your tax method of accounting must be what's used for a purpose of determining your decline. Great if it was optional, because some companies will apply in one, not the other. We were talking about this before. Whether or not the PPP loan proceeds need to be factored into the revenue decline test. Something as simple as wages, the timing of the wages paid. I mean, everyone gets paid typically, a week or two after services are performed, and that could have a difference in what quarter it's in. So and the guidance only has the way I read the guidance, and is that it's based upon when the wages were paid. but it's only briefly mentioned. It'd be nice if something more expansive. And the big one is officers' compensation, which we're going to get to on the next slide. So the question here is, what about wages paid to owners, their spouse, and their family members? And there's a one of the Q&As directs you out to section 51I1 of the code, which is the section of the code that covers work opportunity tax credits. And basically, as I read it, but others read it differently. The related individual are the family members, the relatives of the taxpayer. And in the case of a corporation, the taxpayer is going to be anyone that directly or indirectly owns more than 50% of the stock. I'm of a mind, and I could be wrong, that this is not saying that the owner of the company, his or her wages do not qualify. But if they own more than 50%, any wages paid to any of the family members listed above are not eligible. Now, curious, the one that's not listed is a spouse. So, I know the SCP has asked the IRS to rule on that, whether or not how the spouse's wages come into play. Next slide. All right, so with all this background, and we're getting close to the end. Okay, so how do you claim the credit? It depends on where you are time-wise in the process. Anything from if you determine that you're entitled to anything for 2020 or the first quarter of 2021, your only means of getting a credit is by filing an amended 941 and claiming a refund. And unfortunately, you have to amend each quarter that's applicable. You can't, we'd love to have it, just for one for the entire 2020 tax year, but as of right now, the IRS isn't budging on that. They want every quarter. If you're projecting credits, because if first quarter of, well, we're into the third quarter now. So if the second quarter of 2021 was down by 20%, from day one of third quarter of 2020 that you have a qualifying quarter. What you can do is stop withholding. You don't have to, not stop withholding, stop remitting employee with federal, Social Security, Medicare withholding, or the matching employer, the employer taxes. You do not have to remit those. That's actually the way the government prefers that you handle it. Once you've determined that you're entitled to a credit for the quarter that you are within. And if you've determined that there's not going to be enough there for the remainder of the quarter, at that point you can file a Form 7200 to recover the excess credits that you're not able to get back. Now, there are some exceptions there, but that's a way of going about it after you've stopped withholding. The IRS has mentioned that the 7200 has to be filed or processed, cannot be filed or processed after the filing of the 941 for the quarter. So if you're getting towards the end of the quarter, you're probably best at that point to claim it on the 941. At the end of the day, it all gets reconciled on the 941 at the end of the quarter. So that's the other way of doing it. And one recommendation, if there's any chance that you can get it filed timely as opposed to having to go back and amend a previous quarter, you should look into that, because just from the standpoint of IRS processing times, it's going to be much quicker to get a refund on a timely filed return than an amended return. It could be months to get money back on an amended return. Next slide. Yeah, so we've worked with a lot of different industries that have been able to claim credits, restaurants and hospitality. Construction is an often overlooked one because they are an essential business. But if you recall, there were different restrictions put in place. Your jobs had to shut down for a period of time in certain locations. That could be enough to depending upon how disruptive that was. That could be enough to be considered a partial shutdown for that period of time. retail, not-for-profit, the transportation industry was affected. Dentists and certain healthcare providers, fitness centers, any of those, non-essential businesses. And the credits, as we said before, can be lucrative, very, very lucrative. Next slide. All right, we've reached the end of the presentation. I hope I didn't go too fast, but I really want to get to the question section because I figured that there probably would be some. Like I said, we answer the best we can, but anything that we can address here, anyone can feel free to reach out, and happy to answer any questions or listen to opposing viewpoints as well.
Well, thank you, Jeff and Jen. This has certainly been a terrific presentation, and there's certainly a lot to unpack here. I think, one of the major changes that you both mentioned is that both and that employers can, obtain both the PPP loan as well as the employee retention tax credit. So I think that's a really important change, because when I was researching for this presentation, I went on the IRS and one of the fact sheets said, no, you could not. So I think there is a lot of confusion out there and still some unknowns, as Jeff, you pointed out. So just a reminder for everyone watching to put any questions you have in the comment box, and we're going to get to them all. But just wanted to ask a couple of questions. Are there any deadlines for taking advantage of this tax credit that we should be aware of?
Well, you're subject to the typical statute of limitations, which is 3 years from the filing of the original return is your ultimate deadline. However, there is another deadline that you need to be aware of, and I should have mentioned it before, but for income tax purposes, you can't actually take a deduction on the credit, related to the credit. It's either or, and regardless of what method of accounting you're on, the deduction is supposed to be disallowed for the year of the credit of when the wages were paid. So that would mean that for anyone that's going back on a 2020 credit, to claim a 2020 credit, that disallowance should be on the 2020 tax returns, which if you're on extension and you're a pass-through entity, that they're going to be doing 2 months. So you just want to keep them on. Doesn't mean you can't go back and amend returns, later on, but that's out there for, is on the income tax side, the disallowance of the deduction. And then beyond that, from a cash flow point of view, I mean, like I said before, if you can get them on a timely filed return, your chance of getting the money faster is significant.
And Jeff and Jen, you work with many clients, through the course of your business. Are there any misperceptions that you find working with employers about this program?
I think the biggest one is the one that you touched on earlier, is that they don't think they can get it. And there's with the change, I think there was so much coming at people for so long with the PPP and the employee retention tax credits that everybody at the beginning in 2020 really looked at what was available and right off the bat said, oh, I'm not available to do both, and haven't potentially kept up with all of the changes, and nor has it been broadcast, I think, as much as it was initially. So I think a lot of people think they can't qualify still. And that's the biggest thing that we're trying to get out there, and is just letting people know that this is available and there is still money available. And it's fast money because you're not paying in on the 941. You're not making that payment. So you can take that deduction quickly and get that cash to help sustain the business.
And I'll add to that too. I think that some companies, that we're able to weather the storm. And say the restaurant business, that there was able to really pivot to outdoor dining or takeout, and some of them were able to actually not experience huge revenue declines, and in some cases maybe even made a little bit of money compared to the same quarter 2019. They assume that because they didn't have their revenue, the revenue drop, that they don't qualify. But it's an or test. It's not an and test. If there was a government shutdown and indoor dining was taken away from you for an extended period of time, regardless of, how you were able to, to weather the storm, you can get it. You can be qualified, be eligible.
Great, thanks. We have a question from one of our viewers. Christine asks, are you comfortable with exclusion of PPP forgiveness being excluded for purposes of the gross receipts test?
I can't say I am 100% comfortable.
This is a tough one. I think this is a tough one we keep getting quite a bit. There hasn't been a lot of guidance, or if any, on this. I actually got it yesterday too. It's a hard one, but I go back to, what was the intended use of this? And if you're not double dipping, which you can't, taking the PPP forgiveness in the year in which you take it isn't a revenue item. I mean, it's a really tricky answer. I don't want to say yes or no. I mean, you have to go with your gut on this one, and there isn't any other guidance. So to me, in my opinion, it could be excluded, but there isn't any guidance on it.
I mean, I kind of come at it from and I agree. It's not clear at all that, from a taxable income standpoint, it's if it's forgiven, it's not going to be taxable, and the guidance, as I read it, requires you to use your tax method of accounting. Not that it's a method of accounting, but that's where I'm thinking. But I wouldn't swear by it.
Do you anticipate any guidance on that issue coming anytime soon?
I would hope so, because it is a hot topic question, because a lot of the forgiveness, especially on the PPP loans that people are getting forgiven now,
right,
2021, that's going to come, and that's a cash flow, and you got to separate, I think, the cash flow versus the revenue and the gross revenue test and gross receipts test. It is a receipt of cash, but it's not necessarily revenue.
Got it.
Production, right? I mean, it's a tough one.
Okay, well, we'll come back to that one hopefully sometime soon. So my next question is, and then I'll have a follow-up by one of our viewers who has a question relating to this. Any suggestions to companies that are trying to establish a position that they were impacted by a government shutdown? And we all know, like, all states had all different kinds of rules and regulations. So any suggestions on how companies can go about doing that?
Yeah, first thing, anything that you can get your hands on to have in your file, that explicitly, state, what the specific mandate was, and you want to pull that all together, and and put together some sort of memorandum, with help from legal counsel, as to how this impacted your particular business, because that would be one of the things the IRS is going to want to understand. And then don't lose sight of that 10% threshold, that 10% nominal test. If you could do some of those calculations to show how that is helping your position, that's important. I would suggest that.
So we have a question from one of our viewers, and Jeff, I know you might have touched on this, but this is a specific question regarding the spa industry. There were government regulations set between each client for disinfection protocols. That means 15 minutes of lost time between every client, therefore a loss of potential income. Do you consider this a partial shutdown?
I mean, I think it's I would put that into the appointment basis, sort of. You're no longer able to just have patrons coming on a continuous basis. You have to separate them out. So you need to. That definitely could get you. get you there. It definitely could, depending upon, I suppose it would depend upon, well, how, you'd want to have something in your file. You'd want to document, quantify, okay, what would really, how many people do we really think we did lose by having them adhere to this? If there would have been downtime otherwise, and now you're just kind of spreading it out, that wouldn't be a good fact. But if you're typically going to be, would have been going one after the other, and now you had to have the 15 minutes in between, I think you've got something there. I mean, so, just you want to document it. That's where you use that 10% revenue test, see if you can apply that, and then talk to your legal counsel and document it. I think you have something.
Yeah, and it sounds like also it says therefore a loss of potential income. If you can document, because that's one of the qualifications anyway, there's the loss of income and you qualify.
Right. That might be enough in 2021 to hit the 20% test. And then, I mean, you may not even have to go there to the government mandate.
And any tips you may have for pulling the payroll data together?
Yeah, I tell clients to pay attention to those PPP period dates, the beginning and ending. What's obviously step one, you got to determine what periods you're eligible for. But then once you know when your PPP period started and when the 24 weeks is up, if you look at it and periods of time around that would have been eligible for ERC. Well, that's the first place you'd want to go to grab your ERC. It's easy, all the wages from those periods around your PPP covered period are ERC eligible. And that will, when you do that kind of calculation first to see, all right, what do we have? What more do we need from the PPP period? For wages. So you kind of can manage it that way. So, look at the entire year. Now, for 2021, each quarter is a new quarter. It's a new beginning. So it's a little bit tougher to do that. That's kind of speaking more for 2020. The best way to tackle it when each employee was, $10,000 of their wages qualified. But that's how I usually start. And the payroll companies sometimes need to see it on a per pay period, breakdown, to code their system. So if you can pull together per pay period, I think that's the best way to do it. Allows you to manipulate the data better. Not manipulate, but.
Sure. We're coming up on the top of the hour, but I did want to get to one other viewer comment from Stuart, who says, so in determining the amount of wages between PPP and the employee retention tax credit is as simple as a ratio of wages and healthcare costs divided by total forgiveness time wages for the tax credit purposes. And since there are multiple operating entities, do I do this calculation for each and then apply that overall percentage to the credit for each company?
That sounds right. And so you use the multiple entities you take them all into account together to determine whether you qualify, and then you look at all of their wage, for purposes of how you apply for the credit. Yeah, you would do an allocation based upon each's wages and healthcare expenses. So that makes sense to me. If you want to discuss that one a little further, feel free to reach out offline and I can, in case I'm missing something.
Great.
Yeah, I guess in that quick, if I was reading it as he was typing it, but just to make sure you're not going to take a pay period and double dip, you're going to do the allocation. I feel free to reach out to us because I just want to make sure we're understanding the question correctly.
Thank you, Jen and Jeff. We're at the top of the hour. Really appreciate this very informative presentation. You both mentioned that if anyone has any questions, they can outreach to you quickly. What's the best way for people to get in touch with either one of you?
For me, it'd be email. There you go. jrogers@citrincooperman.com. That's
And
probably
mine
best.
as well. Mine is very straightforward. Hogencamp@citrincooperman.com.
Terrific. Well, again, thank you both for this. Really appreciate it. Very informative. And thanks to everyone who was watching today. And we will see you next time on Chamber TV. So have a great day, everybody.
Thank you. Take care.
Thank you.
Bye.